Alright, so let's begin the show with our viewer queries. And to today, do your life financial planning on the show. I have Anil Rego, founder and CEO of Right Horizons. Anil, good evening and welcome to the show. And in case you're watching the show live and want to send across your questions, you can do that. Once again, we'll flash our WhatsApp number and email ID so that you can quickly note it down. 865-797-4571 and the email ID is themoneyshow@etnow.tv. Alright, so let's begin and let's take Govind Bisht question, and this is via email. And Anil, he says that he wants your advice on his wife's investment portfolio and the financial goals. The portfolio has Parag Parikh Flexi Cap, Motilal Oswal Nasdaq 100. He's got HDFC Small Cap, ICICI Value Discovery, SBI Contra, Motilal Large and Mid Cap, Kotak Equity Opportunity. He's also investing in NPS. He's got his investment going on in EPF as well. And that was his portfolio. Wife's portfolio also has Parag Parikh Flexi Cap, Nippon Small Cap, ICICI Commodities, Nippon Nifty Small Cap and Miro Asset Mid Cap, PGI Mid Cap Opportunity, HDFC Large and Mid Cap, Miro Asset ELSS Tax Saver, SBI Contra, ABSL Flexi Cap, and also investing in NPS. The goal is retirement, after 25 years. The target lump sum that they want to accumulate is somewhere around 12 to 15 crores. And monthly expenses right now that they have is around 50,000 per month. And post-retirement after inflation, how much according to you, your calculation, based on 50,000 requirement now they might need after 25 years. And they also need a corpus for child education and child marriage, around 20 lakhs. And again, 25 years is what they are aiming. They need to factor in inflation for both of these financial goals that they have aligned for themselves, and they also have lined up their emergency fund. Quite a long query. I mean, it would have been better if I had Govind on the phone line with me. But in any case, let's pick up the financial goal, which is, I think, retirement, and let's start with that. And we can also align their funds if at all they are not diversified really well. Anil.
Yes, so I think there are three goals that he's captured. One is retirement, the other is the marriage of his children, okay, and the third is the education of his children, right? So we'll go back to that step by step. Uh, in terms of retirement, he's looking at it for almost like 25 years, and the corpus, assuming that he needs 50,000 as of today, right? Because it's really quite a period of time in terms of 25 years. The target lump sum that he was sort of looking for is, 12 to 15 crores. Okay. And so assuming that, he needs a 15 crore, let me take the higher end of it. Okay. Inflation adjusted and taking care of all of those requirements. Okay. He would actually require, a monthly investment of 72,000 rupees as of today. Now, this actually brings out the fact that when you plan in advance, even if you're looking at something like a 15 crore of rupees, okay, requirement is something like that, 72,000 rupees a month. Now, he could also start it lower because he has a period of time. Typically, it's very.
Anil, can you hear me?
Yes, I can.
All right. So, yeah, I wanted to understand when we talk about inflation adjusted, not all viewers might understand that. Although Govind has really pointed this out, which really means that he knows that they need to factor in inflation whenever they are planning a corpus amount for their future goals. But how can one factor this inflation aspect, and how can you calculate it? Because you're talking about a time frame which is almost 20 to 25 years ahead. So, what all factors would you want to count in to come to a target or a corpus which is inflation adjusted?
Yeah, so typically what we'll look at, the most important part is what is the assumption for inflation, right? So ideally what you will do is you will say, you can use a bit of an Excel calculator and say, if you need 50,000 rupees as of today, right? What would this be 25 years from now? So basically, even using a simple Excel, 1.06, if you're saying 6%, raised to power 25 will give you that figure, right? So, so that becomes, the monthly requirement that you would need 25 years from now, right? The second part of it, which also people miss out, is post, retirement. Also, there is, an inflation that you need to plan for. So for example, if you need, say, 5 lakhs per month, okay, as of that point of time, 25 years from now, then it may actually be higher because in my 25th year, it may be 5, but then again, you need to, that's a slightly more complex computation. You have to assume, what are your life expectancy, and then say for this period of time, you need to plan for it. So possibly that 5 lakhs may even become, say, 7.5 lakhs per month. Okay, so that's the type of numbers that, we would talk about. But for his requirement, and that's what he has looked at, 15 crores, I think for 50,000 rupees a month, that is something that should be, sufficient for him. Okay, he could then, plan for it saying that now I need 15 crores. Uh, let's say 25 years from now, you can just use a PMT calculator of Excel and say, okay, for what is that monthly income that I need? If I have a requirement of 15 crores and I need to do an SIP, let's say, and assume a return. Okay, this time I assume a return to achieve that 15 crores, and the return may be higher. I may take anywhere between 12% if I'm using significantly equity avenues. If I'm looking at hybrid, then anywhere between 8 to 10%. Okay, and then calculate and say, okay, this is what I need. So based on about 12%, okay, so he would require 72,000 rupees a month as of today. So that simplifies. Just his simple thing is I need 72,000 rupees as of today. If I contribute, I'm able to achieve my goal. Now, if it is lesser,
One,
that's my
one
point.
So
Yeah,
one
then
tricky thing is, two of his financial goals are coming together. I think it's
well,
a child marriage and the retirement. So
correct.
for retirement, it's 12 to 15 CR that he needs, and for child marriage, he's aiming so far is 20 lakh, which again, as explained by you, he might need to revisit and reconsider the calculation and the allocation that's been allotted over there. But then this becomes really tricky if you have two important financial goals coming at the same time, Anil. So how do you plan separately for these two important goals?
So typically, you will have to do a planning for each of your goals separately, okay? Because the numbers are different and even the methodology is different. So here, in case of education, you will say, I need 20 lakhs as of today, and then you inflate it. If you, for example, look at 6% inflation, then you only require almost like 81 lakhs, okay? So that's a simpler number and a simpler thing to do than retirement because retirement you have to also plan for inflation post retirement and there's a monthly income also post that. So here it's a simple lump sum. Okay, you require 81 lakhs. I would still think that you could look at a higher rate of inflation. Possibly for a requirement like this, I think it makes sense to gun for at least a crore. You know, almost like 24 years from now. So both of them are sort of bunching together. And yes, then you come back and say, I need 15 crores there or 12 crores as the number may be. And here I need another 1 crore. So totally, I have to, if I have got, let's say I needed 72,000 rupees a month there, here I may require almost like, say, 8,000 rupees a month. So totally, I need to, invest 80,000 rupees a month. Now, it's possible that you may not have this 80,000 rupees a month as of now, but because it is a 25 type of year time frame, I will start with 25, but then I have to keep on increasing. I probably have to keep recomputing it, every 5 years and see that am I on course to achieving it. But after I get to halfway mark, then, I should be actually exceeding, 72,000 rupees because, or 80,000 rupees because I have put in a lesser amount initially. Okay, so that's the point. But normally because of inflation in salaries and all of that, it's what normally happens that you are not able to put in all of it right now. And it's okay if it's that way. But keep in mind that this is what I need to keep increasing it every year with inflation, and I will possibly be able to achieve it.
Anil, any recommendation on the funds? Because you're, we are advising him to increase the SIP. The SIP amount increases and goes in the same existing funds. Is that okay?
Yeah, so that is one of his queries as well. In fact, if you go back and see, he has a whole lot
Yeah.
of funds. So I'm hesitant to, add any funds there. If at all, maybe, replace one or two. For example, he has Motilal Oswal Nasdaq 100, and possibly he can use an actively managed, say, I said, blue chip fund, because I think if you're looking at a 25-year period, I'm not sure a sectoral fund will make sense. Okay, that's where one is also saying that even though Nasdaq would have done well for him right now, okay, but going forward, I don't think you should do it unless you're saying, okay, I will change it after maybe a year or two and keep track of technology and the markets and stuff, and then change it at that point of time. So that is one. Okay, the other is he can also look at yeah, there's a very small allocation, I think, to Nippon small cap 250 index. Okay, uh, that is one option. Either you do an index or maybe a more actively managed fund there. Okay, and I think ABSL flexi cap. My view is you can sort of change that to a HDFC flexi cap. I think broadly then, ideally, if you ask me, it makes sense to also cut out a few funds. For example, he has Miri Asset mid cap and he has PGI mid cap. And if I, he suggested, let's say, either a HDFC mid cap or something, or we cut down one of those funds and, reduce that. If there are multiple in the segment, then you can sort of reduce and cut down so that you have a smaller set. But because he already has enough funds, I'm hesitant to suggest any further funds.
Exactly, yeah. So just stay put and try and increase your investment amount. And yes, you've got your reviewing that you need to do for your financial goals in terms of aligning them once again. Let's move on. And I have Mr. Kannan from Bangalore on the phone line with me. That was a long hold for you, Mr. Kannan. Thank you so much for holding on. Yeah, we can hear you and you can ask your question. I think you want to know something about REITs.
Actually, in this particular multi-asset fund, they will only permanently invest in REITs, some parts in REITs. So I want to know that any fund is available, so I want to know the fund so that I can.
Sure, that's a very interesting question. Any specific reason why you're interested in a multi-asset fund that invests into REITs? If investment in REITs is your interest?
No, actually, I already have contributed on the asset classes. So REITs, I'm not having much like contribution. So if any multi-asset fund which will have that REITs, so that I can contribute for that particular.
All right. All right. You are aware that you can invest in REITs otherwise also, like, barring the multi-asset fund option, you can also invest in REITs if that's the exposure that you're looking at.
But if in that case, how I can do that one? I want to know the detail.
Sure. All right. Pretty clear question now. Anil, what will be your advice?
It's an interesting question. Okay. And yes, REITs basically you'll have to invest it on the exchange, and to that extent, say putting it into an SIP, etc., may be difficult. So it's an interesting way of having exposure to REITs. And yes, actually, a lot of the multi-asset funds today have REITs as exposure there. You have right from ICICI Prudential multi-asset, you have Nippon India multi-asset fund, and HDFC multi-asset, all of which also have REITs as one of the some asset classes that it can invest as part of multi-asset.
All right. Now, could you also elaborate slightly more on investing in REITs, Anil? What could be the ideal situation for an investor to, make this as a part of their portfolio in terms of exposure, and how do we invest in REITs, and what's the tax implication or the treatment involved over there, and what kind of REITs are we talking about? It's real estate, definitely, but then are we talking about residential, commercial? I think we just have 3 to 4 REITs right now in the country as well.
Yeah, so I think you can have REITs, which is real estate investment trust. You have also InvITs, which is basically infrastructure. It invests in infrastructure, toll projects and stuff like that, and power projects, which are yielding, right? So the whole part of REITs and InvITs is that it invests into yielding assets. Okay, so to that extent, it is lower risk than just investing, let's say, in a real estate fund, which is not yielding. So there are, and most of the times the yields are coming from, let's say, commercial rentals, etc., or from tolls, which are not normally available. So it's a good diversification also for somebody to have as a certain percentage as part of your portfolio, even if you have real estate, right? So the good part of it is it's also financial, which means you can enter, exit at far greater ease, right? And where does it come in within the asset classes? You have your debt funds, which, from lower risk, again, within debt funds, you have a whole range of them. You may have liquid, etc., which are very low risk, but as you go higher in, say, income funds, which are sort of longer term, right? So you may have a lot more volatility there based on interest rates because they invest in long-term securities, right? So I think REITs would come one step above, where they are yielding, okay, but they not don't have the equity risk that you have, right? So and typically you may find the yields of these are somewhere around 6%, 6.5%. In the past, we've also seen some of them, and even today, some of the funds in which, for example, may have a higher yield there. So, but you need to keep a little bit of a watch on it because sometimes people mix it up because yields may be there for a period of time. If the project is, for a certain period, and so that it completes, then you may not continue with the particular yield. Or let's say rentals go up or come down, it's not as fixed as, let's say, a fixed income. So keep that in mind. It's in between possibly equity and, say, debt. Okay, it's a higher risk than, say, debt funds, but it's an interesting one. It's yielding, so it's far lower risk than also equity, and that's an asset class to look at.
All right, Mr. Kannan, that's the solution for you, and hope you will go ahead with suggestions given. ICICI Pru Multi-Asset, Edelweiss Balance Advantage Fund, Nippon India Multi-Asset, and HDFC Multi-Asset Fund recommended for your exposure in REITs. On that note, it's time for a quick break, and post that, let's continue the viewer queries section after this break. Welcome back. You're watching The Money Show, and it's a question answer session on The Money Show today. And with me, I have Anil Rego, who is doing your life financial planning. And let's connect with Mr. Ramki from Delhi, who is live on the phone line with us. Good evening, sir. Thank you so much for sending us your question.
Yeah, good evening.
Hi. All right. You want to invest a corpus of 4 crores right now.
Yeah, already 2 crores invested in stocks
Okay.
out of that.
Sure. And you want a return of 3 lakhs per month from this investment from 2 years from now.
Yeah.
After 2
Yeah,
years.
2 years from.
Sure.
Yeah.
All right,
And
sir. Is this your
I'll be receiving another 65 lakhs in July 2006. 2020.
Perfect. Perfect. All right. So before this, you've not diversified in mutual funds. I mean, stock, definitely you are invested, so you know what's direct equity. But you've never had an exposure in mutual funds, right?
No, very little.
Sure. Okay, so let's explain the concept of systematic withdrawal plan also, which Anil will be activated once he decides to park this money in mutual funds, and later on, from 2 years, after 2 years, he needs almost 3 lakhs per month.
Yeah, so I think it's a good thing he's planning in advance, and he is actually keeping a couple of years before he starts reorienting his portfolio. And that's, I think, an important thing for other viewers as well to keep in mind. If you're close to retirement, take at least 2 years before, and then replan and relook at your investments. Uh, for a requirement like this, I think one of the good options is, let's say, the balanced advantage funds, which basically are what we call as dynamic asset allocation funds. And what do they do? Okay, they are hybrid funds, and the ratio, between debt and equity varies depending on the market valuation. Some of them may just have a simplistic ratio like a P ratio, and let me explain that. So as the P ratio goes up, when markets go up and the valuations go higher, then automatically the fund will move into debt, right? So similarly, vice versa as well. As the P ratio falls and markets are falling, okay, automatically, it will move into equity. So what is it doing? It's buying low, selling high within the fund without you having to bother at all. And it's formula based. So there's no judgment of anybody sort of coming in there. So I think the BAF as a category is a fantastic one for him to look at. And 2 years also, I think, is a good period of time. So funds that he can look at there is the Balanced Advantage Fund of an HDFC and even ICICI. Through Balanced Advantage, ICICI is a lot more conservative type of fund. So I think a mix of those in my view may be a good thing for him to look at. And will he be able to achieve that amount? Yes. Funds like these have delivered higher return. Of course, right now they're even showing 13 to 20% type of 5-year return. I think we should not, look at this and plan for the next 25 years. So it's good to plan, let's say, at 8%. And if it comes higher, it's good because then you're also able to increase your monthly, takeaway for inflation. And based on that, 8% you should be able to get 3.1 lakhs a month. Okay, and coming back to your suggestion also, let's look at systematic withdrawals, right? One of the best things about mutual funds is that you can do a systematic withdrawal, especially if you have a retirement type of a requirement. And it's also very tax efficient. Why? Because it withdraws both principal and interest. Okay, and it delays your taxation for a long period of time. So you will find that it's very, very tax efficient. And many of these balance advantage funds again, have equity taxation. So they will also be tax efficient from that standpoint, and it will work very well for him. A tax efficient way of taking out your retirement requirement.
Sure. Mr. Ramki, is there anything else you want to ask Anil?
Yeah, this kind of investing and then systematically withdrawing, could it be could my objective of getting an inflow of 3 lakhs per month starting July 2026 onwards, can it be achieved without eating into the invested capital?
Yes, so
Sure, which is why we are parking your money in assets where your money will grow. Yeah. Anil.
Yeah, because all these funds are funds where returns are higher than 8%. So actually what will happen, you'll probably accumulate more money. Yes, in the short term, you may find market volatility, but because they are dynamic asset allocation, at highs, they will have a low exposure to equity, right? So the falls are lesser. So which is why one has suggested this. And yes, you will actually be able to achieve your requirement. But as you move closer to your requirement as well, and maybe post that, the money that you have in stocks also, slowly you'll have to see how you can de-risk and maybe move to funds like dynamic asset allocation funds.
All right, I think that will be all. That's the time we have on the show for our question and answer session today. Thank you so much, Anil, for taking time out and helping our viewers with their financial portfolio queries. And before I sign off, I'm going to leave our viewers with our WhatsApp number and email ID so that you can send across your questions and get your live financial planning done on the show. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.